Welcome to the deep dive. Today, we're plunging into a fascinating, yet I'd say incredibly precarious corner of the medical technology world.
hmm
We're talking about Senseonics Holdings, Inc., ticker SENS.
Yeah, Senseonics. It's a company that really embodies this profound paradox.
Right. On one hand, they have this truly revolutionary long-term diabetes monitoring tech, stuff that could genuinely change lives.
Absolutely. But then you look the other side, a really precarious financial position. We're talking continuous losses, even a formal going concern warning from their own auditors.
Exactly. So the big question we're tackling today is, can this incredible technological promise actually overcome its very real financial challenges?
And what could that mean for its future? And, for you, if you're looking at this company.
That's the goal.
Our mission today is to give you a concise but still comprehensive understanding of Senseonics. We'll unpack this medtech company, focusing on their continuous glucose monitoring, or CGM, systems for folks with diabetes.
And we're working from an in-depth intrinsic value analysis, current as of July 26, 2025. The share price reference is 0.5778 cents on July 21st.
Right. We'll pull out the key insights, cut through some of the noise, and really lay bare the surprising facts and those core tensions. So you walk away really well informed.
Okay, let's dive in. Let's start by laying the groundwork with Chapter 1, the business of long-term glucose monitoring.
Sounds good.
Mm.
So Senseonics basically operates on a model built around innovation. They design and manufacture their unique implantable CGM systems.
Okay, implantable, that's key.
It is. But here's a critical strategic point. They don't actually handle the sales or distribution themselves.
Oh, who does?
They rely entirely on an exclusive global partner, Ascensia Diabetes Care, for all of that, the heavy lifting of getting it to market.
Okay. So their revenue stream is essentially selling components to Ascensia.
Precisely. Which Ascensia then sells on. And you see this in their financials. A big chunk of revenue is classified as revenue net related parties.
Yeah.
It really highlights how dependent they are on that single relationship.
Got it. Heavily dependent. Now let's talk about the product itself. What makes it so revolutionary, as you said?
Well, the cornerstone is their Eversense CGM system. It's a three-part system.
Okay.
First, there's a tiny sensor based on fluorescence technology that gets implanted just under the skin by a healthcare
They're
provider.
implanted.
Second, there's a smart transmitter. It's removable, rechargeable, and sits on the skin over the sensor. It gives on-body vibration alerts, which is pretty neat.
No need to constantly check your phone for alerts then.
Exactly. And third, a mobile app for real-time data, every 5 minutes. But the real game changer, the key differentiator, is the longevity of that sensor.
How long are we talking?
Well, it's evolved. Started at 90 days, then went to 180 days with the Eversense XL. And now the big one, recently FDA approved in September 2024, is the Eversense 365 system.
365 days. A full year.
A full year from one implanted sensor. And that 365-day version is absolutely central to their growth strategy right now. Looking further out, they're working on Gemini, which aims to get rid of the on-body transmitter, and Freedom, which would be fully implantable.
Wow, a full year from one sensor. I mean, for someone managing diabetes daily, that sounds like a dream, like a set it and forget it kind of experience. No more weekly or bi-weekly self-insertions. That's a huge burden lifted.
It really is. And that core value proposition, that longevity, seems to resonate. They report that 81% of their new patients actually switch from competitors.
That's a powerful statistic. But how big are they overall? You mentioned the Sensia handles sales. Are they making a big dent in the market?
Not yet. When you look at the big picture, Senseonics is a small cap, sort of niche innovator. Their market share is negligible compared to the giants Dexcom, Abbott, Medtronic.
The big three.
Right. Senseonics has a small workforce, maybe 120, 130 employees. And as of fiscal year 2024, they only had about 6,000 users globally. It's tiny in the grand scheme.
Okay, so niche player, but with a potentially game-changing product feature. Let's shift to the broader industry analysis. This CGM market is pretty big and growing fast, isn't it?
Oh, absolutely. It's significant. Valued at $4.6 billion in 2023, projected to hit over $7.5 billion by 2030. That's a solid, roughly 7.2% compound annual growth rate.
And what's driving that growth?
Several factors, primarily the escalating global prevalence of diabetes, over 500 million adults back in 2021, maybe hitting 640 million by 2040, plus rising prediabetes and aging population, obesity. It's all contributing. And the market trend itself is pushing towards convenience, better connectivity, home care solutions.
So a massive tailwind for anyone in this space. But who are they actually up against? You mentioned the giants.
Yeah, and this is where it gets really tough for Senseonics. The competitive landscape is basically a consolidated oligopoly, dominated by Dexcom, Abbott, and Medtronic.
Let's put some numbers on that. How do they compare?
It's stark. Look at Table 1.1 from our source. Dexcom, DXCM. Their G6, G7 sensors last 10-15 days. Market cap around $33 billion. Revenue over $4 billion. Abbott, ABT. Freestyle Libre 14 days. Market cap over $200 billion. Revenue over $40 billion. Medtronic, MDT. Guardian sensor, 7 days. Market cap over $100 billion. Revenue over $30 billion.
And Senseonics.
Senseonics, SENS. Eversense 365 days. Market cap around $400 million. Revenue around $24 million.
Wow. It's not even apples and oranges. It's like apples and watermelons. Or maybe grapes and watermelons.
Exactly. They are a tiny fish in an ocean dominated by whales. And those whales aren't standing still. Dexcom just got FDA clearance for Stelo, an over-the-counter CGM for non-insulin users.
Sure.
That expands the market, sure, but it also cranks up the competitive heat.
Just getting a product approved in the space sounds like a massive undertaking. What's the regulatory environment like and the barriers to entry?
Extremely tough. An implantable CGM like Eversense is a Class 3 medical device. That's the highest risk category. It requires a really rigorous, lengthy, and expensive pre-market approval, or PMA, process with the FDA.
And approval isn't the end of it, right? You need insurance to cover it.
Absolutely critical. Securing reimbursement from payers like Medicare, Medicaid, private insurers, that's essential. Eversense has the necessary CPT billing codes, which is good, but providers still face administrative hurdles to actually get paid for the insertion and monitoring.
Which could make doctors hesitant to adopt it, even if the tech is good.
It could be a friction point, yeah. If it's a headache to bill for, they might just stick with the competitor systems they already know, even if they require more frequent changes.
So the barriers are huge. Immense R&D costs.
Yep. A robust IP portfolio is vital. Senseonics actually does well here. 755 patents globally, 366 granted. Their core tech is well protected, even cited by competitors.
Okay, so IP is a strength. But then there's the FDA gauntlet, building commercial infrastructure.
Massive commercial and distribution infrastructure needed, which, remember, they outsource to Ascensia. And then you have patient and clinician inertia, concerns about cost, insurance coverage, maybe some anxiety about the implant procedure itself, or even just alarm fatigue.
Right. Okay, so let's talk competitive advantage, or the moat. Where does Senseonics truly have an edge, given all these challenges?
Well, let's start with weaknesses. Their brand recognition is very weak compared to the leaders. And critically, they suffer from diseconomies of scale.
Meaning it costs them more to make each unit because they don't make many?
Exactly. Low production volume equals higher manufacturing cost per unit. This directly hits their gross margins, making them poor or even negative sometimes. The giants benefit from the exact opposite, huge scale, lower unit costs.
What about switching costs? If I get an Eversense implanted, am I locked in?
It's nuanced. For an existing patient, yes, the switching cost is high for that year the sensor is in. You can't just take it out easily. So that creates some stickiness.
For a year, anyway.
Right. But the initial hurdle to convince a new patient to commit to an implantable system in the first place, that seems to be their biggest commercial challenge. And there are no real network effects here like you see in software.
So if the brand is weak, costs are high, adoption is a hurdle, where is the moat? What's the real advantage?
It really comes down to one thing. Their unique assets and capabilities.
Yeah.
Specifically, that patented technology, those 755 patents protecting their unique fluorescence-based sensing method. That makes it exceptionally difficult for competitors to simply copy what they do.
So it's a fundamentally different technological approach.
Yes, not just an incremental improvement on existing tech, but something genuinely different. That's their core strength.
Okay, this really frames the core tension of the business, doesn't it? You have this powerful, unique, patented technology,
Right.
but it clashes with a business model that involves a medical procedure, has low sales velocity, one sensor a year versus dozens for competitors, and requires a higher price per unit to maybe someday be profitable.
Exactly. But that price sensitivity is tough in such a competitive market. It creates this structural margin squeeze, as our source calls it.
So the moat is purely technological, not economic.
That's a great way to put it. The whole investment case really hinges on whether Senseonics can somehow achieve massive scale against the odds, or if they get acquired by a larger player who can plug this unique tech into a much better commercial engine.
Okay, That's a clear picture of the business. Let's move on to Chapter 2, Management Evaluation. Who's running the show?
They have a pretty seasoned executive team. The CEO is Dr. Timothy T. Goodnow. He's been there since 2011 and actually came from Abbott Diabetes Care, so he knows the space.
Good background. And the team overall.
Average tenure is solid, about 7.8 years. They've been through the ringer together.
And speaking of the ringer, how has their crisis response been? They've certainly faced challenges.
They really have. They navigated significant FDA approval delays, partly due to COVID-19 disruptions. They managed a very complex commercial partner transition, moving from Roche to Ascensia. That's a huge undertaking.
Right, switching your entire Salesforce partner.
Exactly. And they've tackled tricky capital structure issues. For instance, they got rid of some burdensome debt from Highbridge by converting it into common stock. That simplified things, but
Big dilution for existing shareholders.
massive dilution. That's a key point we'll keep coming back to.
What about transparency and ethics?
They seem pretty consistent with transparency. Regular earnings calls, conference appearances, press releases. CEO Tim Goodnow does public interviews. His compensation, around $3.3 million, seems fairly average for the sector and company size.
And does he have skin in the game?
He does. He owns about 0.88% of the shares, valued at over $4 million. So there's alignment there. We haven't seen any major ethical red flags surface in our research.
Okay, let's talk capital allocation. Where are they putting their money? Or, maybe more accurately, the money they raise.
Their focus is almost entirely internal. It's all about R&D, enhancing the current Eversense system, and developing those next-gen products, Gemini and Freedom. They're not out doing mergers or acquisitions.
Makes sense for their stage.
And recently, there's been a noticeable strategic shift towards capital preservation. They announced plans to cut about $10 million in cash operating expenses in 2025. Basically, trying to make the cash last longer.
Right, trying to extend the runway. And obviously no share buybacks or dividends?
No, none, which is appropriate for a company that's not profitable and burning cash. But the crucial metric here is return on invested capital, or ROIC.
How does that look? Let me guess. Not good.
Yeah, that's an understatement. It's deeply and persistently negative. We're talking figures like 97% to entity 100%.
Wow. So basically, for every dollar invested in the company so far?
It hasn't generated any return. In fact, it's been consumed by losses and R&D spend. It's a clear indicator of value destruction up to this point.
Okay, so that really highlights management's core tension. On one side, you have a team that's shown real skill in technical execution, getting a truly novel device through the FDA gauntlet, navigating partnerships.
Impressive technical and regulatory work, yes.
But all that success has been financed by just massive shareholder dilution. You said shares outstanding grew over 50% in the last year alone.
Over 52%, yeah. It's substantial.
So the critical tension for you, the listener, to think about is this recent pivot towards commercial execution, like the Mercy Health System partnership they announced, and cutting costs, is it too little too late? Can this technically proficient team actually translate that into sustainable financial returns without just diluting shareholders into oblivion?
That's the multi-million-dollar question, isn't it?
It certainly is. Okay, let's dig into those financials more deeply. Time for Chapter 3, a deep dive into the financials.
All right, first off, market cap. As we mentioned, it's around $405 million currently. That puts SENS firmly in the small cap or even micro cap space. High volatility, lower liquidity, generally higher risk.
Got it. How about revenue growth trends over, say, the last 5 years?
It's been inconsistent and volatile, and always from a very low base. There was a big dip in 2020, likely COVID-related, and a strong rebound through 2023. But then revenue sort of stagnated in 2024.
Why the stagnation?
The company attributed it mainly to the product transition, phasing out the older models to focus on launching the Eversense 365. Their trailing 12-month revenue as of March 31st, 2025 was just under $24 million.
Okay, $24 million. Now for the really tough part. Profit margins. Gross, operating, net. What's the story?
It's not pretty. Let's start with gross margin. It's been highly volatile, sometimes even negative, meaning the cost of the goods they sold was higher than the revenue they got for them.
Selling dollars for 80 cents, basically.
Something like that at times. Fiscal year 2024 saw a tiny gross profit of only $500,000, and that was after accounting for nearly $5 million in one-time charges related to that product transition.
Any signs of improvement?
There was a glimmer. Q1 2025 showed a gross margin of 24.1% as they started selling the higher-margin 365-day product. But the long-term history is weak.
Okay, what about operating and net margins?
Deeply negative. The company has never achieved operating profitability. Their operating margin is around minus 296%.
Minus 296%.
Yes. For every dollar of revenue, they're losing almost $3 just running the core business. And consequently, the net margin is profoundly negative, around minus 312%. Huge net losses year after year. Negative $78.6 million in 2024, negative $60.4 million in 2023. Their accumulated deficit, the total losses piled up over the years, is nearly $1 billion. Yeah. $962.1 million, to be precise.
Almost $1 billion in accumulated losses. That's stark. And those losses must mean they're burning through cash, negative free cash flow.
Absolutely. A consistent, significant history of cash burn. The recent trailing 12 months showed negative free cash flow of $35.3 million. In 2024 alone, they burned through $60.5 million just in operating activities.
Which underscores that critical dependency on external financing we talked about. They need cash infusions just to keep operating.
Constantly.
So let's talk financial stability. Earnings consistency.
Well, it's consistent on a clear, unbroken trend of substantial net losses for the past decade. They simply haven't shown any ability to generate positive earnings.
And the balance sheet. Debt to equity.
Highly leveraged and fragile. As of the end of 2024, debt was $54.8 million versus equity of only $21.1 million. That's a debt-to-equity ratio over 2.5x.
Which is high, especially for a loss-making company.
Very high. But it gets worse. The Q1 2025 report showed negative stockholders' equity of negative $17.2 million.
Negative equity, meaning liabilities exceed assets.
Exactly. Technical insolvency. From an accounting perspective, they're underwater. If they liquidated everything tomorrow, they couldn't cover their debts.
And this is where that formal going concern warning comes into play.
Precisely. It's not just us saying they're fragile. It's in their official 10Q filing. Their auditors expressed substantial doubt about the company's ability to continue operations for the next 12 months without raising additional funding. It's a serious red flag.
But they do have some cash on hand, right? What about the current ratio?
Yeah, their short-term liquidity actually looks okay on paper. The current ratio was a healthy 6.88 recently. That's because they did manage to raise capital. As of Q1 2025, they had about $64.2 million in cash and equivalents.
Okay, so they have a buffer.
A buffer, yes, but it's finite. And given their cash burn rate, that buffer is actively being consumed month by month.
Right. It buys them time, but doesn't solve the underlying problem. And dividends are obviously not applicable.
Not even on the distant horizon.
Okay, so with earnings being negative, how do you approach valuation analysis? PE is useless.
Completely meaningless. You can look at price to sales, PS. At around 18 times trailing 12-month sales, it's a dramatic premium.
18x sales for a company losing so much money.
Yes. It reflects extremely high market expectations for massive future growth. Compare that to profitable competitors. Dexcom trades around 61x PE, Medtronic 25x, Abbott 17x. Those are earnings multiples, but Senseonics sales multiple is in that ballpark.
So traditional relative valuation is tricky. What about intrinsic value?
For a company like Senseonics, where all the value is theoretically in the future, a discounted cash flow, DCF analysis, is really the most appropriate conceptual approach, even though it's fraught with uncertainty here.
Right, because you have to make huge assumptions about the future.
Exactly. You have to forecast free cash flows far out, assume they eventually become positive and grow, estimate a terminal value, and then discount it all back using a discount rate, the WACC. That reflects the very high risk.
So what kind of value range does a DCF model suggest, keeping in mind those huge uncertainties?
Well, it's extremely sensitive to assumptions. The revenue growth rate is the most critical driver. You might start with management's 2025 guidance. They're guiding for $34–38 million, which is 50–70% growth, and then assume high but decelerating growth after that, maybe tapering to 2.5% long term.
And the discount rate has to be high, right?
Absolutely. Given the unprofitability, cash burn, negative equity, going concern warning, intense competition, you need a high WACC, maybe in the 12% to 15% range, or even higher, to properly reflect the profound risks.
And you have to assume they eventually reach future profitability.
You have to, or the model breaks. You assume gross margins eventually expand, maybe towards 25–30% consistently, and then operating expenses grow slower than revenue, creating operating leverage.
So plugging in some plausible, albeit optimistic, assumptions, what kind of number pops out?
Our source material provides an example using a sensitivity analysis. If you assume, say, a 13% WACC and a 2.5% terminal free cash flow growth rate, the implied share price could be around 70 cents.
Okay, $0.70, which is above the current price of 0.58.
It is, But again, that hinges on achieving that turnaround. More aggressive, maybe less plausible, assumptions could push that value over a dollar. But the range is wide, and the assumptions are heroic.
So the financial summary is pretty stark. Senseonics survival isn't funded by its operations, it's funded by capital markets. Its valuation is entirely a bet on a distant, highly uncertain future payoff.
Yeah, sums it up perfectly.
All right, let's shift gears now to part two, the broader context and risks. We'll start with chapter 4, market sentiment. How's the market feeling about SES?
It's really interesting. Despite the financials we just laid out, sentiment among Wall Street analysts is overwhelmingly bullish.
Really?
Yeah, the consensus rating is actually a strong buy. The average 12-month price target sits somewhere between $1.41 and $1.55. That implies, potential upside of 140% to 180% from the current price, around $1.58.
Wow. Who's putting out these targets?
We've seen recent positive initiations or upgrades from firms like TD Cowen, $1.25 target, Lake Street Capital, $1, and HEC Wainwright, $1.40. So analysts are definitely buying into the long-term story.
Okay, that's the analysts. What about recent news impact and media tone? Is it matching that bullishness?
It's more of a polarized mix, really. You see positive news driving excitement, things like product milestones, especially the FDA approval for Eversense 365. Analyst endorsements get coverage. Strategic partnerships, like with Mercy Health System or the integration with Sequel MedTech's aid system, generate buzz.
And insider buying too, right?
Yeah. The CEO's open market purchase back in December 2024 was seen as a strong positive signal. But then you get the other side. The bearish sentiment pops up whenever the financial realities hit earnings reports showing big losses, continued cash burn, announcements of dilutive stock offerings. Those things tend to cause short-term price drops.
So a battle between the future story and the current reality.
Exactly. But overall, the forward-looking growth narrative seems to dominate the general media tone more often than not.
What are the technical market indicators telling us, like short interest?
Short interest is meaningful and persistent. It's been hovering around 6.5% to 7.2% of the float. That means a significant number of shares are being borrowed and sold short, betting the price will go down.
Is that high enough for a potential short squeeze?
The days to cover ratio is relatively high, around 8.5 days. That means, based on average trading volume, it would take shorts about 8.5 days to buy back all their borrowed shares. So yes, it could fuel a short squeeze if there's a sudden, strong, positive catalyst. Historically, short interest in SENS has been quite volatile, sometimes exceeding 30%.
Interesting. What about the price relative to moving averages?
This is also quite interesting right now. The share price, around DOGRAM 58 cents, is trading very close to both its 50-day and 200-day moving averages, which are also hovering around $57.58.
What does that typically signify?
It often suggests a neutral or consolidating short-term trend. The market seems undecided, kind of waiting for a signal. Technicians often see this kind of coiling action as preceding a potentially significant price move, either up or down.
So it sounds like a genuine market standoff.
That's a perfect description. This convergence of price near key moving averages is like the technical picture reflecting the narrative battle. You've got the bulls, the analysts, the positive news flow pushing the future growth story, versus the bears, the short sellers, the grim financial reports highlighting the current cash burn and dilution. The stock seems coiled, just waiting for a decisive catalyst to break the deadlock.
Fascinating picture. Let's turn our attention now to Chapter 5, ownership structure. Who actually holds the shares of Senseonics?
The ownership structure is quite revealing, actually. What stands out immediately is the remarkably low level of institutional ownership. We're talking only about 11% to 12% of the shares outstanding are held by institutions.
Only 11–12%. That seems really low for a publicly traded tech company.
It is very low. And the institutions that do hold it are mainly the big passive index funds, Vanguard, BlackRock, State Street, who have to own it because it's in certain indices.
So not many active managers choosing to invest.
Right. While some speculative hedge funds might hold positions, there are also signs of institutional selling in the recent past. Jane Street liquidated a position. UBS reduced holdings, according to our source. It strongly suggests the broader institutional investment community, the so-called smart money, is largely staying on the sidelines, likely due to that precarious financial profile we discussed.
Okay, institutions are mostly out. What about insider holdings and recent transactions?
This is where the picture gets more interesting. Insider ownership is relatively high, somewhere between 4.5% and 8.5%. That includes CEO Timothy Goodnow's 0.88% stake, which we mentioned is worth over $4 million.
And you mentioned insider buying.
Yes. Crucially, there have been recent open market purchases by insiders. The most notable was the CEO himself buying 315,000 shares for just under $100,000 back in December 2024. That's generally considered a strong signal of confidence from those who know the business best.
So if institutions hold only 11–12%
Yeah.
and insiders hold maybe 5–8%, who owns the rest?
The general public, retail investors, they hold the vast majority, over 81% of the stock. This means Senseonics has a highly diffuse and fragmented ownership structure.
What are the implications of that?
Well, the lack of large, concentrated institutional shareholders means there isn't really a significant outside force providing stability or strong governance oversight. This often contributes to higher stock price volatility. Retail sentiment can swing more wildly than institutional views. It also creates this fascinating ownership dichotomy.
Insiders buying, institutions avoiding.
Exactly. Insiders with the deepest knowledge are putting their own money in. Broad institutional investors are largely staying away. It forces you to ask, who has the better insight here?
A key question. And the high retail ownership means...
It means there's potentially a smaller institutional floor to absorb selling pressure if that positive narrative starts to falter. If sentiment turns negative, there aren't as many large long-term holders to potentially step in and stabilize the price.
Makes sense. Okay, let's move into the Chapter 6, risk assessment. We can frame this using a classic SWOT analysis. Let's start with the strengths.
Okay, top strengths. Number one, that unique and heavily patented technology, 755 patents, is a serious IP moat. Second, the compelling patient value proposition with the 365-day sensor, attracting that 81% conversion rate. And third, an experienced management team that has navigated some very choppy waters.
All right, now the weaknesses. These seem pretty clear from our earlier discussion.
They are. Chronic unprofitability and high cash burn are top of the list. The precarious financial position, negative equity, the going concern warning, heavy dependency on external financing, leading to that constant threat of dilution. And finally, a lack of commercial scale, resulting in those diseconomies of scale, weak brand recognition, and that heavy reliance on Ascensia.
Okay. How about opportunities? Where's the potential upside?
Well, the market itself is a huge opportunity, large and growing addressable market for CGMs. Their product pipeline is potentially transformative with Gemini and Freedom. There are opportunities for market expansion, perhaps moving more significantly into type 2 diabetes monitoring or deeper integration with automated insulin delivery aid systems. And as I touched on, its unique tech makes it a plausible potential acquisition target for a larger player.
And finally, the threats. What external challenges do they face?
Intense competition from those dominant, deep-pocketed players is the biggest one. Regulatory and reimbursement risk is always a factor in medtech. Approvals can be delayed, reimbursement rates can change. And the rapid pace of technological change is a constant threat. What if a competitor develops something even better? Or maybe even a non-invasive solution?
Beyond those industry-specific threats, what about broader key macroeconomic factors? How vulnerable are they?
Quite vulnerable, I'd say. High interest rates make future borrowing more expensive, which is a problem when you rely on external capital. It also makes safer investments look more attractive, potentially pulling investor money away from high-risk stocks like SENS. High inflation is also a threat. It can increase their cost of goods, sold for raw materials, components, labor, squeezing those already thin or negative margins even further, and accelerating the cash burn.
Okay, and our source highlighted a specific geopolitical risk. U.S. imposed tariffs of 2025. Tell us about that.
Yeah, this is a significant and maybe underappreciated threat. The analysis points out that medical devices were not exempted from the broad-based tariffs imposed in 2025.
So if Senseonics imports components,
Tariffs on those imported components would directly increase their cost of goods sold. For a company already struggling with negative gross margins at times, this would have a direct, immediate, and negative impact. It would worsen the cash burn and could potentially force them to seek another highly dilutive financing round even sooner than planned.
So putting it all together, what's the core risk thesis for Senseonics?
It really boils down to this. Senseonics' greatest vulnerability is its own balance sheet. Its internal financial fragility magnifies every single external threat: competition, regulation, macro headwinds, tariffs. The entire investment case is essentially a bet on the company achieving escape velocity.
Escape velocity meaning?
Meaning successfully scaling revenue, achieving profitability, generating positive and sustainable free cash flow, doing all that before some external shock combines with their internal financial weakness to trigger a terminal liquidity crisis. It's a race against time and their own financial limitations.
A very high-stakes race. All right, let's bring it all home with Chapter 7, Conclusion. Let's synthesize everything we've uncovered today.
Okay. Senseonics clearly presents this stark contrast, this classic high-risk, high-reward profile. It's all rooted in that fundamental conflict between its incredible technological promise and its harsh financial reality.
Let's summarize the bullish points first. What keeps the hope alive?
You've got the innovative 365-day implantable CGM, genuinely unique, a compelling value proposition for patients, reducing the burden of diabetes management, attracting users from competitors, that strong IP moat with 755 patents, a large and growing market providing tailwinds, a potentially transformative product pipeline, strong endorsements from Wall Street analysts despite the financials, and tangible insider buying showing management conviction.
Okay, a solid list of positives, but the bearish points are just as significant, if not more so.
Absolutely. You have the long, unbroken history of significant unprofitability, high persistent cash burn, an extremely weak balance sheet negative equity, that explicit going concern warning, massive shareholder dilution that has eroded value, being a tiny player fighting against overwhelming competition, troublingly low institutional ownership suggesting the smart money is wary, and a business model with inherent friction due to the medical procedure involved.
So when we loop back to the valuation summary, how does that DCF analysis with all its caveats compare to the current stock price?
As we said, the DCF yields a wide range because it's so sensitive to assumptions about future growth and risk. Under assumptions that are optimistic but perhaps plausible, like 13% discount rate, 2.5% terminal growth, the model can generate intrinsic value estimates above the current share price, maybe around 70 cents, potentially higher, with more aggressive inputs.
So what's the final concluding outlook for Senseonics? Is it undervalued, overvalued, fairly valued?
Comparing the current price around $1.58 to that DCF range, the stock appears undervalued only if you, as an investor, have extremely high conviction. Conviction in management's ability to execute a very difficult multi-year turnaround. That means successfully scaling Eversense 365 sales dramatically, hitting ambitious revenue targets, significantly improving margins, and finally achieving sustained profitability and positive free cash flow.
And doing all that while fighting off giants.
Exactly, while navigating intense competition. So Senseonics really isn't a traditional value investment. It's much better characterized as a publicly traded venture capital style speculation. The potential rewards, if they succeed, could be substantial. But the risk of significant or even total capital loss is equally substantial. It's binary.
High risk, high reward indeed. So let's end with that provocative thought for you, the listener. Given this extreme financial fragility and the truly formidable competitive landscape, what do you think is the most realistic path for Senseonics to finally achieve that escape velocity? Does it really rely on massive organic growth against all odds? Or is an acquisition by a larger player who wants that unique tech the more probable endgame for this technologically brilliant but financially challenged innovator?
Something to definitely mull over.
And that wraps up our deep dive into Senseonics Holdings, a truly captivating case study of groundbreaking technology battling profound financial challenges.
Yeah, definitely one to watch. And if you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to the Stock Analytics AI YouTube channel.
That's right. And remember, our $4.99 a month members get priority for deep dives on the techers they request. Plus, over the next few months, we at Stock Analytics AI are covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives.
And if you just want a one-off deep dive on a specific ticker, you can always drop us a super thanks.
We appreciate the support.
And one final important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Definitely.
Thanks for joining us today, and we'll see you on the next deep dive.